This fund is a concentrated fund that invests predominantly in quality global equities. It has a very broad remit and can invest in pretty much everything, but predominantly we're invested in good businesses with stable or growing moats that are long-term compounders.
So this fund invests in quality companies. So we believe that high quality companies outperform the market over the long run. What we mean by quality, we're looking for companies with high or rising returns on equity or returns on capital, but very importantly, sustainable returns over time. So we spend a lot of time thinking about the competitive advantages of the companies we're investing in. We're looking for companies with wide or expanding economic moats that can really drive that sustainable return over the long term.
So about 70 to 80% of the fund is invested in these sort of traditional great quality names. 20 to 30% of the fund is in stocks that we would call improvers, where they may not fit the definition of traditional quality companies at the moment, but we think that they're on a path to improvement because they have improving competitive advantages.
So this is an active, concentrated fund. We are bottom-up stock pickers, so the majority of the performance from this fund comes from stock selection. And so as a result, one of the main risks is stock-specific risk. So we have to make sure that we are very much on top of the companies we're investing in, always testing the thesis to make sure that nothing is going wrong with the investment cases. And this is also, as I mentioned, a quality portfolio. So we have a style bias towards quality. So there will be times when quality is underperforming. For example, when low quality cyclical commodity stocks are rallying, that will be painful for this fund. Or if interest rates are really surprising above what the market expects, this fund will invest in stocks with high duration of earnings. And so those stocks will be under pressure. But by sticking to the philosophy of process, we would expect to, over the long term, outperform the market.
We view ESG typically as a proxy for quality, and we like to see that all our companies, we want to know what the risks are, basically. So we do a lot of thorough ESG analysis. But it's not an ESG fund, and it's sort of incorporated into our overall perspective of the companies that we're investing in and the risks that they are running if there are problems, we think, in particular areas, rather than being sort of an ESG mandate in particular. Personally, I think it's a core product. I have most of my own wealth in the product.
One characteristic of this fund is that it's got good upside and downside capture. So the fund tends to outperform the market in up markets, but also tends to fall less than the market in down markets. So for clients that are looking for a fund that is very focused on risk management, this fund can be very appropriate.